The role of banks in modern economics is as important as it is confusing. Banks can make an economy work, but also destroy it in an instant. People around the world, Argentina, can tell you about that time when they went to the bank and they were told the money just wasn't there. Can you imagine that? To understand what banks do, we must first spend some time understanding why they came about. We just assume banks exist, but why? From its humble beginnings as a record-keeping service, banking has evolved into the complex global financial system we see today. This video will explore the origins and evolution of banking, emphasizing key milestones such as the earliest banks, their role as record-keeping institutions, the introduction of double-entry bookkeeping, and the issuance and adoption of bank-issued currency. The earliest recorded example of banking dates back to ancient Mesopotamia, around 2000 BCE, where temples and palaces served as rudimentary banks. Temples, considered sacred and secure, were entrusted with storing grain, silver, and other valuables, presuming that people wouldn't dare attack a temple. There was one prominent case of someone famous doing this, but that's a video for someone else to do. We're explaining banking after all, which is definitely uncontroversial. One notable example is the Temple of Shamash in Babylon, which not only stored wealth but also provided loans, often in the form of grain, to farmers and merchants. The Roman Empire further advanced banking. Roman argentari, or private bankers, provided a range of services including loans, currency exchange, and deposit holding. These bankers were central to the economic life of the empire, serving merchants, landowners, and even the state. Their innovations in financial management set the foundation for modern banking. In their earliest form, banks were primarily record-keeping entities, documenting financial transactions to ensure accountability and trust. Mesopotamian bankers recorded transactions on clay tablets detailing loans, repayments, and interest. These records served as binding contracts, fostering trust between borrowers and lenders. In ancient Egypt, granaries functioned as proto-banks, with scribes meticulously recording deposits and withdrawals of grain. Farmers received receipts for their surplus grain, which could be traded or used as collateral for loans. This system linked record-keeping with economic activity, enabling the efficient management of resources. Medieval banks in Europe, such as the Bank of Venice and the Bank of Genoa, continued this tradition of meticulous record-keeping. They maintained ledgers to track the accounts of merchants and governments, facilitating trade and economic growth in burgeoning city-states. A remarkable example of record-keeping comes from the Inca civilization in the Andes. The Incas used quipus, intricate arrangements of knotted cords, to record information. Each knot and string represented specific data, such as population figures, taxes, or agricultural yields. While quipus were not directly tied to banking, they highlight the universal human need to manage resources and maintain records. This sophisticated system enabled the Incas to govern their vast empire without a written language, illustrating the critical role of record-keeping in economic management. Early banks focused on a few core functions that supported economic activity and social stability. Temples, palaces, and early banks served as secure repositories for wealth. This service was crucial in times of instability, protecting communities' resources from theft or natural disasters. Lending was a primary function of early banks. Farmers borrowed grain from plantings, repaying their loans with interest after the harvest. Similarly, merchants borrowed funds to finance trade expeditions. Roman argentari specialized in such loans, charging interest to compensate for risk. As trade expanded, banks facilitated currency exchange, allowing merchants to transact across regions with different coinage. This service was vital for international trade and economic integration. Some early banks acted as fiscal agents for governments, collecting taxes and financing state projects. Roman banks, for example, played a significant role in managing public finances. The issuance of private currency by banks was a revolutionary development, emerging as trade and economies became more complex. This practice began in the Renaissance period and gained prominence during the 17th century. During the 13th century, Italian merchant banks developed bills of exchange, documents promising payment of a certain amount of money at a specified time and place. While not a currency in the strict sense, these bills could be traded among merchants, reducing the need for carrying heavy and risky coinage. One of the earliest examples of paper currency came from Stockholm's Banco in Sweden. Faced with a shortage of precious metals, the bank issued banknotes as a substitute for coins. These notes were redeemable for a specific amount of silver or copper and quickly gained acceptance for their convenience. By the late 17th century, private banks in England began issuing their own banknotes. The Bank of England, established in 1694, issued notes to raise funds for the government. While other banks could issue notes, the Bank of England's association with the state lent it significant credibility. In the United States, the absence of a centralized banking system led to a proliferation of private banknotes in the early 19th century. These notes, often backed by gold or silver reserves, were widely circulated but varied in value depending on the issuing bank's reputation. Over time, governments and central banks began monopolizing currency issuance to ensure stability and prevent the risks associated with private notes, such as counterfeiting and overissuance. But we'll talk about this in the next video. The adoption of bank-issued currency depended heavily on trust in the issuing bank and the stability of the broader economic environment. In the early days, banknotes were accepted primarily within local communities or among merchants who trusted the issuing institution. Inconsistent quality and frequent counterfeiting limited their acceptance. How did the Bank of Amsterdam begin? The Bank of Amsterdam was founded during a period of rapid economic and commercial growth in the Dutch Republic. Amsterdam had emerged as a major trading center, attracting merchants and financiers from across Europe. However, the growing volume of trade brought with it significant financial challenges. Merchants traded across regions that used diverse and often inconsistent coinage. Coins from different countries varied in weight, metal content, and quality, causing confusion and inefficiencies in trade. Debased or clipped coins further complicated transactions, as their actual value often differed from their face value. Amsterdam's growing importance as a trading hub required a reliable and efficient payment and settlement system. Merchants demanded a secure institution that could ensure fair valuation and exchange of diverse currencies. The Bank of Amsterdam comes as a solution to these problems. What is interesting is that it comes as a solution to global trade. People are trading far and wide. There is no central system of coinage and there is no central system of clearing loans and deposits. To address these issues, the city of Amsterdam established the Bank of Amsterdam in 1609. The bank's primary purpose was to provide a secure and standardized system for currency exchange and deposit banking, thereby stabilizing and enhancing the city's financial infrastructure. It arises in Amsterdam because the city is a hub of trade. It is also a testament to the ingenuity of the Dutch to invent a financial instrument that makes trade easier. Several factors contributed to the Bank of Amsterdam's unparalleled reputation for reliability. The bank operated on a full reserve banking system, meaning it held reserves equivalent to the full value of all deposits. Unlike other banks of the time, which often lent out deposits and risked insolvency, the Bank of Amsterdam guaranteed that depositors could withdraw their funds at any time. This policy eliminated the risk of bank runs, fostering trust among merchants and depositors. We will talk more about bank runs in our modern banking video, which will include a lot of people actually running. The bank standardized the valuation of diverse coins, ensuring that merchants could trade with confidence. Depositors exchanged their coinage for an equivalent value in bank money, a ledger-based currency, which was universally accepted in Amsterdam. Bank money was based on the intrinsic value of high-quality coins, making it more stable and reliable circulating coinage. The bank was owned and operated by the city of Amsterdam rather than private individuals or state officials. This governance structure minimized the risk of political interference and ensured the bank's primary focus remained on supporting commerce and trade. The bank maintained meticulous records of all transactions and implemented stringent auditing practices. These measures enhanced confidence among depositors and trading partners. The Bank of Amsterdam functioned as a clearinghouse for merchants, simplifying complex financial transactions and reducing the need for physical currency transfers. This service was especially valuable for international trade, where payments often involved multiple currencies and parties. Despite its early successes, the Bank of Amsterdam faced challenges in its later years. In the late 18th century, the bank began lending against its deposits, deviating from its original full reserve model. This shift undermined the bank's stability and contributed to its eventual decline. The rise of other financial centers such as London and the establishment of the Bank of England eroded the Bank of Amsterdam's dominance in international finance. However, the bank's legacy endured. Its emphasis on stability, transparency, and trust influenced the development of modern banking systems and central banks. The Bank of Amsterdam is often cited as a precursor to contemporary central banks, demonstrating the importance of sound financial practices in supporting economic growth. The bank's association with the British government gave its notes a significant advantage over those of private banks. By the mid-18th century, Bank of England notes were widely circulated and eventually became the foundation of the modern pound sterling. The widespread issuance of private banknotes led to rampant counterfeiting, undermining public confidence. Some banks issued more notes than they could back with reserves, leading to inflation and financial instability. For example, the collapse of Stockholm's Banco in 1668 was caused by excessive note issuance. Let's take a closer look at this case as an illustration of this problem. Stockholm's Banco, established in 1656, holds a significant place in the history of banking as one of the first institutions to issue paper currency in Europe. Although innovative in its approach, the bank's mismanagement and subsequent failure highlighted the challenges of early banking systems and the risks associated with issuing currency without adequate safeguards. Stockholm's Banco was founded by Johan Palmstruch, a Dutch-born financier and entrepreneur, with the approval of the Swedish monarchy. At the time, Sweden's economy was expanding, but its financial infrastructure lagged behind. The country relied heavily on metal coins, particularly copper, which were bulky, inconvenient to transport, and subject to fluctuating values. The bank was established to address these issues and fulfill several key objectives. First, provide liquidity. Stockholm's Banco aimed to facilitate trade and economic activity by offering loans and credit to merchants and businesses. 2. Ease the burden of copper coins. The Swedish government issued large copper plates as currency, which were cumbersome and impractical. The bank sought to replace these coins with a more convenient medium of exchange. Third, modernize Sweden's financial system. Inspired by the Bank of Amsterdam, Palmstruch envisioned Stockholm's Banco as a catalyst for economic modernization. Stockholm's Banco began as a private enterprise but operated under a royal charter, aligning its goals with those of the Swedish state. One of Stockholm's Banco's most notable contributions was its introduction of paper currency in 1661, the first instance of such an innovation in Europe. These notes, known as kreditivsedlar, were issued as a substitute for the cumbersome copper coins. The banknotes promised the bearer the right to redeem them for a specific amount of precious metal. The benefits of these notes were immediately apparent. Paper currency was lighter and easier to transport than large metal plates. Banknotes simplified transactions, especially for merchants conducting large-scale trade. By issuing notes, the bank could expand the available currency without requiring additional coinage. This innovation marked the beginning of a new era in European banking and set a precedent for future institutions. Despite its groundbreaking introduction of paper currency, Stockholm's Banco failed just a few years later, in 1668, due to a combination of poor management, overissuance of notes, and lack of regulatory oversight. Several factors contributed to its downfall. First, there was an overissuance of banknotes. Stockholm's Banco issued far more banknotes than it had reserves of precious metals to redeem them. This practice, while initially expanding the money supply and stimulating the economy, eroded public trust in the bank. When depositors and note holders began to demand redemption in silver or copper, the bank could not meet the demand, triggering a financial crisis. This is an early case of a bank run. Palmstruch also underestimated the risk of issuing unbacked paper currency and failed to implement adequate controls. He assumed that most people would not redeem their notes simultaneously, a critical misjudgment in an era when trust in banking systems were still fragile. The Swedish government provided the charter for Stockholm's Banco, but did not establish sufficient regulatory mechanisms to monitor the bank's activities. Without oversight, the bank's practices became unsustainable, leading to systemic risks. Also, Sweden's reliance on copper currency and the fluctuating value of precious metals created an unstable economic environment. The issuance of paper currency further destabilized the system, as the lack of trust in the banknotes amplified economic uncertainty. By 1667, confidence in Stockholm's bankos had severely diminished. Depositors rushed to withdraw their funds and redeem banknotes for metal reserves, leading to a classic bank run. The bank could not honor its commitments, forcing it to suspend operations. Johann Palmstruch was held personally accountable for the bank's failure. He was arrested and sentenced to prison for mismanagement and fraud. The story of banking is one of trial and error. Bankers and central bankers learned one valuable lesson. Relying on one single person to issue currency without any controls or safeguards can be really dangerous. Although it seems like this is something we moderns have solved, it is not. Almost all banking crises involve some form of this happening, whether it is central banks being cavalier with printing money or private banks making loans that are likely to go belly up and issuing paper on the back of those loans. It's a more complicated system, but the fundamental issue remains the same. Double-entry bookkeeping, first formalized by Luca Pacioli in 1494, revolutionized banking by providing a systematic method for recording transactions. This innovation ensured accuracy and transparency, making it indispensable for banks handling complex financial operations. Why is it essential? 1. It prevents errors. By requiring that accounts balance, double-entry bookkeeping reduces the risk of mistakes. 2. It enables growth. The system allows banks to manage extensive networks of accounts, facilitating expansion. Third, it builds trust. Accurate records enhance confidence among clients and investors. Prominent Italian banking families such as the Medici adopted double-entry bookkeeping to manage their vast financial empires. This innovation allowed them to track debts, credits, and transactions with unparalleled precision. Banking, like any other technological innovation, can be awesome or awful. It depends on who uses it and what the safeguards are. Here we've described banking prior to the invention of the central bank as a monopoly issuer of currency. Before we go into modern banking, we have to talk about central banks and why they came about. As always, this is a story of trial and error, with some pretty crazy trials that cause some weird and destructive errors. In the next video, we will go over the history of central banks. Strap on, it's going to be a bumpy ride.